welcome. Today we're going to be talking to Feroz Aziz all about debt funds. Feroz, in the last couple of months, there's been a very sharp spike coming in on the 10-year, which is basically a sharp spike coming in the yields of the 10-year bonds. Usually yields are inversely related to the price, which clearly means a debt bond or bond price have been coming off while yields have been spiking up, and that is leading to debt funds giving negative returns to investors. Is it time to be worried about this phenomena, or is it time to just stick it in there and eventually things will settle down for the debt market?
Samina, I think there are three things which are important when we are discussing debt funds in the current situation. Point one is debt funds and debt in one's portfolio is largely to bring stability to the portfolio rather than taking risks. So ideally you should stick to debt funds which are shorter in maturity and have lesser risk of the movements of interest rate. Point one. Point two is whenever there is an interest rate movement upwards or downwards, there is a change in the value of the bonds which are underlying held in the debt fund. So it's important for all of us to understand why is that change actually happening. Point one is, if you have bonds in your portfolio and you have locked yourself an 8% return, for example, and if the interest rate goes to 9%, market interest rate goes to 9%, it is obvious that you have locked yourself a lower interest rate at 8. So what happens is the market starts undervaluing your bonds because they're stuck at 8, whereas the rest of the market is getting 9. So, and vice versa, if you have locked yourself an 8% interest and if interest go to 7, your bond is far more valuable because it has been smart to lock in 8%. So this inverse correlation understanding is critical. Lastly, what should one do? In the debt market, generally there is not too much to panic, because in the debt market you are either advancing the return or delaying it. So a person should not panic in the current situation, if I have to give a synopsis in terms of a recommendation to start with.
You know, can you take us through why are we seeing negative returns most importantly? So of course, stay put, invest in short-term funds, but let's take a step back and tell our viewers what has led to the negative returns in debt markets.
See, it's very important, very nice question, Samina, because we have to understand and dissect the reason why something happens. As any adversity happens to your portfolio, it's very important to understand the magnitude and the source of the adversity, and understanding the cause and effect relationship is an important part, an integral part of investment learning. So there are 2-3 reasons why this has happened. Point one is, now we have understood the 10-year GSEC movement upwards will lose you money in bond funds because there's an inverse relation. Why has the 10-year GSEC moved up? Point one is that crude prices have gone up. Because of crude prices going up, inflation can be impacted. I'm oversimplifying stuff, but just to give you an example of why inflation would go up. Inflation goes up because crude oil prices go up, indirectly transport goes up, and indirectly all the fruits and vegetables prices go up because they need to actually be transported. So that's one reason. Dollar has strengthened is another reason. Rupee has depreciated, the dollar price has appreciated, so that's second reason. These are the two very important reasons why there was a sharp movement in the yield, and that's why there's an impact. Secondly, what has happened is a government or the RBI has made very strict norms to make sure that all the bad debt of PSU banks has been recognized. I'm again oversimplifying stuff and not using technical jargon. So since we have squeezed out liquidity from the market, and that's where prices actually go up, so that's one reason. And lastly, what has happened is US bond yields have gone up, by which I mean the 10-year GSEC of India has some degree of correlation, and in fact a larger degree of correlation to US 10-year bond yields, and they have spiked. So people in India, foreign investors, pull back money to invest in their own country because they're getting good return there. So there's a flight of capital from the Indian market to the global market. So these are a few reasons, simplified of course. There is more to speak of it, but for simplification's sake, we stop there.
Feroz, we had very recently the RBI monetary policy where rates were hiked by 25 basis points. The stance was neutral. In these in this situation where rates are expected to only go up from here, I would imagine that short-term funds still are the preferred investment route. But what about FFPs and also debt-oriented hybrid funds? How do those look?
See, I think the first move of RBI increasing interest rate has come after about 2014, if I'm not wrong. So it's been long period since we have not had an interest rate movement upwards. But in my opinion, there are not going to be a series of movements upwards, because there has been a neutral stance given, and there is lower inflation target for the second half of the year. So I'm not too worried about further interest rate movement significantly. And even if RBI increases interest rate, bond prices actually don't depend on RBI's movement. They depend on 10-year GSEC, which is a 10-year yield, but RBI only moves rates, repo and reverse repo, which is overnight lending rate. So coming back to your point, I think answering the pointed question, how do hybrid funds look? Not so good. They don't have a tax advantage, which they did before April 1st, at least the balanced funds did. So I would not take the hybrid funds. I would not take the funds in the debt category, which are complex interest rate related debt instruments, namely dynamic bond funds and income funds. But I will still stick my neck out and go into short-term funds, because you're going to get 8.5% in a good short-term fund. And I think aspiring to make more than that might not be a very prudent thing on the debt side. You might end up making lesser money than a good short-term debt funds. Of course, there are several. Making a right pick is even more critical there.
What are the realistic returns one can expect from short-term funds, Feroze?
See, Samina, after the September reversal of the 10-year GSEC, and it's been going up, what has happened is the yields of these short-term funds have gone up to as much as 9.5% to even 9.75%, but there is an expense of 1.5% depending on the fund you choose. So expecting a 8 to 8.5% for a 3-year investment also doesn't look unlikely. I think I've given enough teasers, so naming the funds would be very appropriate. So you have to look at a Franklin corporate bond fund, which can give you 8 to 8.5% for a 3-year holding period. Also, a Birla medium term fund has one of the highest yields post expenses, which is upwards of 8%.
Right, thanks, Feroze. That's all one needs to know when you're looking at investing in debt funds. Feroze highly recommending short-term funds given the current interest rate setup, and of course the fact that yields have also been spiking in the recent past. With that, completely out of time. Thanks for watching.